Welcome to The Explainer. Today, we're digging into a recent analysis that makes a pretty compelling, data-backed case for one of the world's oldest assets. With all the economic jitters out there, the source we're looking at asks a really big question. Could the answer to stability be something tangible, something ancient? Could it be gold?
So the analysis we're breaking down today really starts by tapping into an anxiety a lot of us are feeling. It's a question that's probably on your mind right now when you look at your finances. Okay, let's dive right into this.
To really build its case for gold, the source first has to paint a picture of the problem. And we're not talking about just some vague feeling of worry. It's describing a modern economic landscape that's filled with very specific pressures that are kind of forcing investors to rethink their old playbooks.
The analysis points to these things right here as creating what's basically a perfect storm of uncertainty. Any one of these would be a challenge, right? But when you put them all together, they create this environment that's driving people to look for what they call safe haven assets.
So with that as the backdrop, how does gold actually perform? Well, the source doesn't just look at what happened last week or last year. No, it takes the long view, a really long view, to build its case that gold has been a consistent store of value over time.
And wow, the scale of this climb is pretty staggering. We are not talking about small little fluctuations here. The data shows this dramatic upward trend for nearly a quarter century, starting from under $300 an ounce back in 2000. And based on this trend, the source is actually projecting a price of over $3,300 by 2025.
And the analysis really zooms in on this recent period of intense global stress. It frames this huge price jump not as some kind of speculative bubble, but as a flight to preservation. Basically, investors moving their money into an asset they believe will actually hold its value when everything else feels so uncertain.
Okay, so this brings us to the absolute core of the argument. It's one thing for an asset's price to go up, but the analysis connects that growth directly to protecting you against inflation. That silent thief that's always eating away at your money's buying power.
And boom, here is the central data point from the article that really makes the case. Over the last 5 years, while U.S. inflation was averaging 4.2%, the source says gold's average annual return was a whopping 11.3%. The argument is simple. It didn't just keep up with inflation, it crushed it.
The source then explains why gold can do this. Its value isn't tied to a company's earnings report, or what its CEO says, or even what the central bank does with interest rates, not in the same way stocks and bonds are. This independence, the article argues, is what lets it act as a stabilizer when the stock market goes haywire. All right, so the analysis then does something really smart. It shifts from talking about you and me, the individual investors, to some of the biggest financial players on the planet, central banks. The idea here is to see what the smart money is doing.
The source just lays this question out there, and it's a sharp one. It highlights what seems like a major contradiction. If gold is just some dusty old relic, why are the world's most powerful financial institutions buying it up for 13 years straight? It kind of suggests their actions tell a very different story about gold's role today.
And this isn't just some vague trend either. The article points to specific countries like China, Russia, and Poland, noting that they've boosted their national gold reserves by billions of dollars in just the last 24 months alone. This is presented as hard evidence of a real institutional shift toward the metal.
And according to one expert they cite, this isn't just about the big banks. There's a generational shift going on. Younger investors are apparently starting to see gold as this unique asset that actually exists outside of the traditional financial system.
So this all brings us to the final big idea in the analysis. The author says, hey, maybe you should think of gold less like a high-growth tech stock you're hoping to get rich on, and more like a safety net, kind of like a financial insurance policy for your entire portfolio.
And to make this insurance idea really hit home, the source shows what a $10,000 investment would have turned into. For instance, if you put that money in back in 2005, it would be worth over 50 grand today. So the argument is it didn't just preserve your purchasing power, it grew it a lot.
The article also makes a super clear distinction about how to own gold. It really argues for direct ownership of the physical metal, coins or bars that you can actually hold, over a financial product like an ETF, which it basically calls a paper claim that just tracks the price but doesn't give you true ownership. And these examples right here are used to just hammer home that portfolio insurance idea. The article points to two of the biggest financial crises of our lifetimes to illustrate its main point. When other stuff is tanking, gold tends to hold steady or even go up. And honestly, this might be the most interesting takeaway of the whole thing. The analysis totally leans into gold's reputation for being kind of slow and steady. It basically says, yeah, gold is boring, and in today's world, that's its superpower. Its stability isn't a weakness, it's its greatest strength in a chaotic market.
So, the analysis from GoldMogul leaves us with this final thought, and it's a question that really reframes the whole investment conversation. It pushes you to think beyond just chasing the highest returns, and to really consider what matters most in your own financial strategy. Is it all about growth, or is stability the ultimate prize?